Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today I'm going to rip through some questions that people have on YouTube. I'm going to obviously interject my opinions across it. And I see a bunch of comments that maybe I don't completely agree with, and I'll tell you why I don't agree with them. So let's go through here and take a look at the questions and why I think there might be differences in how perhaps I look at the situation a little bit differently. So one of the questions someone said is, you can end large inflationary swings by returning to a precious metals monetary standard. 50 years versus 2,500 years. Above ground gold increases 3% annually. World population increases by 1% per annual. Please tell me where that doesn't mean 2% inflation per year if we return to the gold standard and return to a time without fractional reserve banking. Would need a reset and a revaluation, but that is not unheard of and has historically been common. 1/5 of the world does not practice fractional reserve banking even today. Well, uh, your calculation is just wrong. Uh, you're not calculating above ground gold versus world population. That's the wrong calculation. The way that they measure inflation is through the consumer price index, and they're measuring the prices of items. So if your above ground gold is increasing 3% annually, you're comparing that against the goods production rate. It has nothing to do with world population. So the price in terms of ounces of gold is a relative metric against the cans of green beans that you produce and uh, the number of homes that you produce, et cetera, et cetera. So then what really you're doing is you're pricing those items as a ratio of that item versus the number of ounces of gold. The population, you're not measuring your number of ounces divided by the population. So it's not ounces per human. It's that's not consumer price index, and that's not how they calculate inflation. So I think if you were to measure it completely different, you would have massive deflation because we are producing the number of cars and staplers and crayons. We're producing that at a faster rate than 3% annually, which means the consumer price index would go down in terms of number of ounces of gold. But that's also why gold has been such a good investment, and other precious metals and commodities is because they're increasing the money supply at a faster rate than gold, silver, and all these other ones. What we haven't seen is that money rotate back into it and account for the majority of the M2 money supply in the system. That only occurs under certain market conditions where people are forced out of bonds and forced out of stocks through interest rates increasing. And that is where you're going to get your big revaluation. So if you're looking to be an investor, the only way that you can make money is you front run where the money flow is about to go. That is literally it. And that includes stocks and those with earnings, companies with earnings. Now, if you've got a company that is in a very large growth phase and they're growing rapidly, yes, it can outperform everything. But if it's a large corporation that's very, well established, you're not going to beat the money flows. You're going to have to go with a declining interest rate environment, and money is going to flow into stocks or wherever that equity is going to do well in the market conditions that are present. That is literally what I found when I looked at all of this in research investing. So number one, gold is increasing at a slower pace than things being produced, mass produced, and that would be deflationary, not inflationary. That's what my opinion is there. Someone says COVID cases are picking up after months when it seemed like no one was talking about it. All of a sudden, it's back. What a coincidence. Yeah, and they're going to have to somehow slow down the the inflation. They're going to just have to stop the economy, and maybe that's what they're trying to do. I don't know, and it's just a coincidence. It is. Coming down, um, someone had said that's why debt to GDP ratio of 130% makes it virtually impossible to fight inflation, as higher rates cause the government to print money to pay the increased interest on the debt, and which then causes more money printing to control yields. The doom loop. Yeah, that is the doom loop. Totally agree. The reason we're in this situation is they're fighting the credit expansion, which is inflation from the real estate market. And Japan didn't run into that situation. So I know some people will say, well, Japan had this huge GDP, debt to GDP. Yeah, but they didn't have the inflation pressure from the population. So what they did is they could print all this money, but there was no credit expansion on the commercial banking side. And if you look, their demographic was going down, their inflation was going down. They had disinflation or deflation or flat. And the government was trying to make up the difference through all these QE packages to try to get inflation to go up. Um, they couldn't do that because of the demographic. The low inventory in housing is largely due to people not selling their old house, because then they'll have to refinance the purchase of their new house with much higher rates compared to what they're still enjoying now. So the low inventory presently is artificial. That makes no sense. That makes absolutely no sense. If a person like myself who owns one house, which I think is the majority of people, if I said, you know what, I'm going to go buy $1 million house. Well, where's that $1 million house going to come from? Now, there's going to be people who are going to be swapping homes, so to speak. But somewhere in this mix, if you have more buyers than physical inventory, you need more physical inventory. So you need new homes to be purchased. And if new homes are being purchased, that is a credit expansion. Low inventory is a function of more demand than supply. It's just that simple. And the way that you build back your inventory is to build more new homes. You have to build more new homes, and more new homes is inflationary. So I've heard this a lot. Well, people aren't going to sell their house, guys. This isn't a. If how do you move if person A who owns one house moves, they sell their old house and another person buys it, they have to go and buy another house or at least rent. A home has to be consumed when they move away from their house. So a new home needs to be consumed from the house that they just sold. It's not net zero if you've got more buyers than sellers, and that's where the demographic of new home buyers coming into home buying years is so important to understand. That's why the inventory is low. It's not artificial. If you think it's artificial, please in the comment section, how does inventory go down? How does inventory over time go down? And tell me how that is possible over time. I'd love to know how inventory would go up by people selling their house. Let me know how that works on a big grand scheme of things. Where if a person is selling their house, the only way that you could do that is if your death rate is greater than the number of new home buyers coming into the system. The problem is the number of new home buyers far exceeds the death rate of older individuals. The baby boomers are a smaller demographic than the millennials, which means in the game of musical chairs, there's not enough chairs to purchase. Now, the weird part is if you go to buy a house and they're all very expensive and the affordability is off the charts, the way that they can get more affordable homes, they're going to have to build smaller homes. Just flat out build smaller homes. Now, there could be a situation where basically you just can't afford the house. And there's going to be people that are just left out. And if the inflation continues to go up and the cost of new homes continue to rise, that is going to rise all of the homes in the system because you're choking the new home builds coming into the system through the affordability. So if you choke the new homes coming into the system, the houses are just going to be priced at a level that prices out people. And that's, I think, where we're at today. The mortgage rates have obviously amplified the affordability problem. But if rates were to go back down, I think that new home builds are going to go way up. There could be more movement in the system, but all that does is increase the wealth of real estate agents as the velocity of homes going through the system increases. People just decide to move and inventory churns. It doesn't mean that you have enough homes. It just means that they're selling and they're churning the inventory. Inventory turns. It says, do we get inflation or rather deflation because people may not be able to pay their bills anymore? This level of interest rates should cause rather deflation. So I don't know if being able to afford bills will necessarily cause deflation. I think it depends on. So you have someone who's got a blank checkbook who is running massive deficits. They can't afford it, but they have a blank checkbook where they just create the money. That's the government. So that is massively inflationary. Now, there's going to be individuals in the system that are not going to be able to pay bills. And if they pay it by a credit card, increasing credit from credit cards is inflationary. And it would be deflationary if they couldn't pay their credit card bills. And they couldn't pay their mortgage, and their mortgage then defaults. That would definitely be deflationary in that type of event for that person and for the entire system. The question then is the level of defaults in the system, which is deflationary, overcome the deficit spending that the government is doing? I don't know. That's what we're going to have to find out. Because if they're running multi-trillion-dollar deficits, I don't know if we're going to have defaults be in the trillions. That's something that we'll have to see. And this guy says we're going to get both inflation followed by hyperinflation and then deflation. There are consequences to spending our children's future. Someone says you could open up a new credit card with a sign-up bonus. Whenever I have a big upcoming purchase, this is what I do. And that's what I'm gonna do here recently. I'm gonna purchase some new windows on a house. And I've been getting all these different quotes. And guys, the quotes vary massively between them. I've had quotes like $50,000, $60,000, $70,000, and I've had quotes as low as $17,000. And I would say that the difference in window quality is not that big of a difference. It's all just different companies and the perceived difference of value between the windows. And it's a pain because obviously all the dealers think that their windows are the best and that they've got the best technology and the best warranties and all this other stuff. And when you go to research all this stuff about the windows themselves, there is a vast difference between opinions on what a good window is and what a bad window is. And that can vary dramatically from salespeople to the window installers, because obviously the installers should know which windows are the best if they're installing a wide range of windows. But yeah, let me know in the comments section what you guys think are the best windows, or at least the best value. It doesn't have to be the best like at all, on everything, but the best value window. And remember, I'm in Colorado, so it's got to be available in Colorado. It can't be, Okna where I don't get that, or some other window. And hopefully Okna is a good window. That's what the window installers seem to like. But yeah, let me know your guys' opinion down below. It says one thing inflation is there's one sector it hasn't really affected yet: wages. Everything is about to double of what it was a few years ago. Oh, come on. Why did it go all the way up when I hit expand? There we go. One thing with inflation is there's one sector it hasn't really affected yet: wages. Everything's about to double of what it was a few years ago, except most hourly wages. That puts a lot of stress on the working class, and there will be a need to make up for that just for survival, rent, groceries. I think we can expect that in the next few years. I know for me, inflation has doubled the cost of just about everything from water heater to a bell pepper, but my wages have only gone up 5%. This means I've had to stop investing and saving more, only dealing with the money I invested years before. The prices on most goods are not going to come down at this point, and therefore more hours need to be put into work in order to have some cash left over to invest again, taking me away from the last couple of years with my kiddos. Crappy situation they've put us in. Yeah, I agree with that. But I also think that the system is set up where we're going to have inflation no matter what. So what you're going to have to do is find a new job or do something different. I think over the years. I mean, look at me. I'm doing YouTube and all this other stuff just because I think the people who are getting hit the hardest are the white collar jobs. The blue collar jobs, I think, are not getting hit that bad. At my work, we've given pretty big wage increases to those that are hourly. The salary people are just getting decimated. So if you're just a regular guy that goes and has a salary, you show up to work and you just rely on the merit increases, your merit increases are going to be, 3% or 3.5% or something like that. The hourly people, they're getting, I think, more opportunities to increase their wages. And some people we've done out of cycle increases in wage living adjustments and stuff like that. And the salary people don't get that. I think the salary people are probably the most going to get hit the most. That's what I've seen around me. Let me know what you guys have around you. Put it in the comment section. I'd love to hear your opinions on it. But yeah, there's a lot of stress in the working class for sure. This guy says, I'm a wage earner and I've always known that wages will never keep up with inflation. That's a given. The American people supported these massive injections of liquidity into the financial system. Therefore, we Americans are to blame. At least we are on this channel buying assets. Think about the 95% of Americans who have no idea what's really going on. And money being created in the system, inflation, credit being expanded, it's going to impact assets, and asset prices will go up. That is where the name of the game is. You want to buy assets. You want to buy assets. And if you notice, I've talked a lot about dividend income. Dividend income can supplement the income that you make from your job. So you're buying assets that throw off cash flows for you to enjoy or spend if you have to. Or you could use it to save and recycle back into investments to grow that dividend income. Growing the dividend income is important because that's another way that you can grow your income, have assets at the same time, and be somewhat inflation protected. Depending on what that company is, if you're in a commodity company that's very inflation sensitive, like an oil company or natural gas company or something, then you're going to have a lot better inflation sensitivity, and you can get dividends from that asset. And that's very important to continue to increase your income. And that is one way that you can do it and try to, I'll say, get in front of the inflation that we have. So I'm doing it multiple ways. I'm increasing my dividend income. I'm trying to work more across the board. I'm trying to save more. And then the dividend income will start to snowball. And what that means is, if you're getting a couple $100s a month of dividend income, or whatever it is, it can snowball and it starts to accelerate. It turns, $200 of dividend income turns into 300, which turns into 500, which turns into 1,000, and then it really starts to snowball when you get over a certain threshold. It kind of grows slow in the beginning, more of a linear growth. Then it turns into geometric or exponential growth towards the end. So, when you get to 10,000 a month, you can save 8,000 of it or 9,000 of it, and then it just keeps piling in. So that is important. If you guys want to know how to dividend invest, you can check the findingheightenvalue.com. I've got a lot of dividend paying companies, and I'll go over that in the next question and answer session that we've got. And I also have a dividend a bunch of dividend companies that I've listed on the website that you guys can look at if you want to. And again, I'm going to put another 50% discount code if you guys want to join. It's called September, and that'll go active right now. I'll make it active today. Um, and this is someone saying no one knows where the top is and no one knows where the bottom is. It comes down to buying what you think is cheap and selling when you think a profit is enough without getting greedy, as there are no buyers at the top, which is why things crash. Well, there's buyers at the top. It's all retail buyers. And you have to define what that top is. What I'm going to do is I'm going to sell when it gets to the more expensive side, or if the market is satisfied with the supply demand and the credit basically dies, the credit expansion. So after the millennials, after the millennial wave comes through home buying years, that's when the potential for the credit to really slow down, and that's where the market conditions will change. So I agree. No one knows where the exact top or bottom is. What you're doing is you're finding where the value is in the system and where the market conditions put a tailwind behind your investments. And that's where you make all your money. That's the only way that I know you can make the money. Because when something's cheap, money has to flow into it to make it expensive, which means that that money has to flow from something else that is overvalued into the undervalued asset. Camco, the Kingdom. No, and I think it is. I think that was when it was far, far, far away. I think I was referring to the Yellow Brick Road. What's that called? The Yellow Brick Road, whatever that is, that movie. I can't even remember it right now. Um, Forrest Gump, far, far, far away. I literally save 70% of my monthly salary. My monthly living costs are less than 2,500 bucks all in for everything. After that, it's just buying precious metals, buy commodity companies, and pay for Andy's website. That's where my money goes. I'm not cheap. I really don't even look at price when I need something. I look at what kind of value it will bring to my day-to-day life, and is it worth it? Thanks, Andy. Yeah, Joe's killing it. Thanks for all the I know that you put a lot of comments in the comment section, so thanks to Joe. I know that you're one of the people who comments the most. Hopefully that you're loaded in the companies that are doing quite well. Um, Look for dividend payers. Look for dividend paying companies. They seem to be very resilient. They have all the infrastructure in place. Some of these new mines that are coming online, they're going to be hit with inflation. So a lot of the estimates and break-even costs that they have are probably very low compared to what the actuals will be when they go to build a mine. And that will be a tailwind behind the price of the physical commodity itself. So if you're playing this game and you don't want to take on the risk, I would say a low risk way to play this is to buy the physical metals because the cost curves are going to continue to increase through the inflation. Some of these commodity companies that have infrastructure in place already, I think are going to do incredible. That could be offshore drilling companies. It could be drilling companies that are onshore too. It could be the companies that are oil and nat gas that have infrastructure in place that can use cash flow to fund growth if they need to. It is oil and gas companies that have future drilling locations, a lot of them, in jurisdictions that I would say are pretty safe. That's where I think all the money is going to flow in the future, because if we do get tied in oil, it's going to be where is the exportable oil at and can they export it? As countries become wealthier, their exports, if they hold their production steady, their exports decline, and the exportable oil, I think, will become less over time. Um, yeah, SMR says some of my uranium stocks have doubled. Boss Energy for one, others have gone nowhere. None are down. He bought in January of 2021 for my money. Denison Mines is a much better choice. It correlates well with UUUU, I guess, has liquidity and outperforms most others. Also, Energy Fuels comes to mind, which is you got what I need. Can you do a video on metal swapping? Yeah, so metal swapping, what you do is you use the ratios for making your decisions on what metal to own. And you can go to a dealer, go to your local dealer, and see what the requirements are for swapping and how they do it. Some dealers, if they're local, do not play in the palladium or the platinum metals as much. They're mainly only gold and silver. Other dealers they're glad to set up platinum and palladium. My dealer can do all of them, and you can go in there and ask, hey, what's your premium that you're going to pay, or what are you going to pay for an ounce of gold or whatever it is? And the premiums will differ based off of the size of the metals. They're going to pay less for a 100-ounce bar than they are for a 1-ounce round. So if you can get deals, it's better to buy silver at like 1-ounce rounds, 5-ounce or 10-ounce bars or something like that than it is over the very large bars. And the dealers, they have requirements from a tax perspective. They are required to do a 1099, which is basically a tax reporting event. If you trade in a single transaction, metals in quantities that are greater than, silver is 1,000 ounces, gold is 25, platinum is 25, and palladium is 100 ounces. So if you transact at greater quantities than those, there's a 1099 that needs to be done. There is different requirements for American Eagles, and I don't think there's a 1099 that needs to be done no matter what the transaction size is. So American Eagles, at least if you're in America, there is no transaction size, from what I understand. Check the rules on that to make sure that what I'm saying is accurate. I'm not a tax advisor. I don't know the tax codes, to the T. But I think it's something like that, and you can do further investigations on it. So generally speaking, in history, if you were to look to see when the most favorable time to buy assets is, it's when the ratio of the metal is the cheapest against all of the metals. And that is a anomaly, is what I'll call it. There's been anomalies in history, and if you guys want to check the time frames of when to purchase, silver, well, I'll start with palladium just because I know palladium better. Palladium had an anomaly in 2009 and in 2005. If you were to look at the pricing of palladium in 05 and 09, it was very cheap. And then it went up dramatically. You're talking, $100 or $200 per ounce for palladium during those years. And in 2020, it peaked at close to $3,000 an ounce. An absolute massive gain for palladium in dollars terms. In 2016, the rhodium was the cheapest against all the metals in 2016. Rhodium was the best deal, probably, that I've seen of any metal in 2016. It was incredibly cheap, and that went from a price, I think it was down at around $600 or something like that, $700, and or it might have been less than that, $600, I think. It went all the way to $28,000 an ounce in 2020. I mean, I think it peaked in 2020 or 2021. So what you want to do is you want to swap your metals back and forth between these metals given the ratios. And if you tie in market conditions, that will also help you figure out what metal is the best and how cheap they are. So if right now, platinum is the cheapest metal because it's the cheapest against all the different metals. It has gained purchasing power against the other metals to some extent. We were at 0.34 platinum to palladium ratio, and now it's at 0.7 something. So it's actually doubled. It's over doubled since the bottom, and that's where I swapped my metal. I got real lucky with my timing. There was a lot of fear, and I did it based off of the cost of the transaction too. I said, there's no way that the cost of this transaction is going to get lower here. So I went into my dealer. He gave me a really good deal on the palladium. I got a good deal on swapping it to platinum, and I swapped it to platinum. I was also looking at silver to do it, but the premiums were way high on silver, and I thought I could get a better deal on platinum. So I decided to go with platinum. I also wanted to diversify, and I already owned a bunch of silver. So that's what I ended up doing, is swapping to silver in April of 2020, or swapping to platinum in 2020. I also have more access to silver, as silver is much more popular on Craigslist, on eBay, on local transactions and people. So I wanted to diversify into platinum, and I was actively buying silver at the same time from people locally who had the old mindset. They didn't know that if they handed in their silver to the dealer, that they were going to get over spot for it, $1 or $2 over spot in some cases. What they did is they said, you know what, I just want to sell this, and I'll give it to you at spot, because that's what the dealer would do. And I was like, okay, I'll take everything you got. Granted, it took me a little bit of time to buy it all, but I'm finding deals even today where people are willing to sell silver on Craigslist, and I know what real silver looks like, and so I don't think I'll get scammed or anything like that. If you've never purchased silver before, I probably wouldn't do it. But if you know what silver looks like, you can do some ping tests. You can kind of see what roughly the same, the sizes are. And if you're buying well-known items like, coins like American Eagles, there's no fakes of American Eagles that I know of. And if you look at the coin, I'm sure you could tell if it was going to try to be faked. And you got the ping test. Another thing that you can do is you can also stick to well-known refiners and manufacturers of silver. So, you've got a bunch of, we'll say, a bunch of well-known refiners or minters or whatever you want to call it. You can kind of just say, yeah, this is what it looks like. This is what it is. And you kind of just get to know the whole silver products that are out there. So I've gotten really good deals the entire time looking for on Craigslist and other, probably Facebook too, Facebook Marketplace. And I'm not saying, a best practice here, if your guys are gonna deal with individuals and you're gonna go through Facebook or something like that, what I would recommend is go meet at a bank that has security and cameras. Do the exchange there. You can, if you're selling, you can put the money right into the bank right there. So you don't have the cash on you anymore. So you go into the bank, you do the transaction, you deposit it, and then you leave with no money. He can't steal or try to steal it. He or she can't try to steal it. And it's all recorded. It's all there in the bank. If you are buying, then you can buy the metal at the bank, but you're still going to have to take that metal and somehow leave with it. So, and you can obviously wait a good amount of time for that person to leave before you leave. So you can also mitigate it through that. Or you bring a friend or whatever it is. You have multiple people. So that's what the metal swapping game is. The metal swapping game is a way to play the markets without having inflation or deflation risk. Your risk is having to need to sell it at a poorer time when it's cheap. But if you're accumulating and you don't need the money in the short term, you can buy it when it's cheap and then just sit on it for maybe even 5 years, 2 years, decade. It depends how fast the ratios move, and you're going to have to be patient for that to occur. But I've made really large purchasing power gains doing that ratio swapping method with precious metals, physical metals. So that's why I'm gonna end it there, guys. There's a lot of information there, and that's where we're gonna have it. Looks like my camera froze or something like that. So we'll end it there. Give me a thumb up for the content. Subscribe to the channel, and we'll catch you guys next time. This is Finding Value.